Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is June 10th, 2018 edition of Market Outlook. So the first thing to note is the weekly charts, and certainly what's clear is that the IWM has the best momentum and price action. So here's the weekly. One thing you can see from the highs in the beginning of 2018, right? IWM is the only key index that's been able to regain and have the strongest momentum as of the close on Friday, right? You can see our momentum charts here in the beginning of 2018. We have now reached higher levels both in price and momentum. Not true with the NASDAQ, although the NASDAQ still very, very strong. You're in bullish phase across the board, both in our real motion indicator. So price and momentum net confirming, but just not as strong as the IWM. And again, everything else looks pretty much intact. And it looks like we're getting ready at some point to at least attack the all-time highs in these lagging indices, while these things sort of potentially hit a parabolic move to the upside. Now, on the daily charts, what I think is the most important thing to focus on is the S&P 500. So in terms of just synthesizing all this data down, right, you can see we're above the 10-day moving average across all of the indices, and everything is in bull mode, right? You've got virtually all of the moving averages across the board, even the 50, which had been waning on the Dow, on the S&P, waning on the Dow, now turning back up. That's really positive news. We like a positive slope. So the takeaway is IWM is the strongest. We've got another inside day pattern, so that could be played as well with a tight stop around that 2-day pattern. Now, the thing here to note is, right, you've had this sideways compression, which over the last 5 or 6 days we broke out from in the S&P. So the 10-day moving average and that very, very clear support zone is right around 274. A break and a close under 274 in the S&P could be a harbinger of another potential sell-off. So I'm looking at 274 in the spiders as important support, and that will definitely be critical to watch, even relating to the other indices. If we can't hold that level on any weakness here, that could definitely put a drag on the rest of the market. In terms of key intermarket relationships, the S&P versus utilities is a great risk-on, risk-off indicator, and that has markedly improved. So if you take a look, we're at the best levels in just about a year or more, right? So where we had a bit of a concern, we did end up holding on the recent sell-off, the 6-month intermarket ratio here, right? This line here is a moving average of the relationship between the two. That relates to the 6-month. The black is the 1 month, and we are above that. And as you can see, utilities look like it's in trouble. Stocks, on the other hand, in a bull phase. So this key intermarket relationship moving up very, very nicely, and in fact, in the strongest position we've been in some time. The next thing is the other 4 key intermarket relationships. The only one that's of concern is high yield debt, junk debt, risky debt, still underperforming U.S. bonds. So that could be early warning. Now, what we do is, of course, we use a blend of all these key intermarket relationships. Right now, the S&P versus bonds doing quite well, no problem there. The S&P versus gold also on a lot of strength. And, of course, inflationary pressures picking up here. So when wood outperforms gold, that's definitely showing you potential inflation. And as a risk-on, risk-off indicator, when wood is outperforming gold, that's good. Of course, gold often has issues in terms of looking at it as an alternative investment to stocks. And in essence, when wood is outperforming gold, that is sort of taken off the table, and then you're more concerned about inflation. When you have inflation, you have two scenarios. Stocks can go up in an inflationary environment or not, but generally that's better than having gold outperforming wood where it's a pure anxiety play. So net, when I look at this, we got 4 out of our 5 key intermarket relationships in play, showing risk on. The next thing to point out is that volume, which had been a concern, has definitely improved a bit. So as you can see, it's almost an even shot in the number of accumulation days versus distribution. That's an improvement over the last couple of weeks. It's not extraordinary. I would expect more volume to come in as we attack the highs in the Dow and in the S&P. But net overall, you can see right now we're in a neutral state between accumulation and distribution, which is an improvement. And of course, in terms of just general price movement for the week, the Dow up 2.8%, really strong performance. That puts all of our key indices year-to-date positive for the year. That is definitely a positive sign. And the leader here, of course, is the NASDAQ 100 with FANG stocks just pretty much on fire. So in terms of sector performance, we have more confirmation of the bullish situation in the markets. And that is one, utilities down 3% for the week. So considering a week where equities were extremely strong and utilities extremely weak, risk on definitely in play, confirmed by this particular sector. The other thing that was pretty interesting is the retail sector had a immensely strong week, up 6.3%, and the more discretionary, speculative type of sector, consumer discretionary, was up 3%. So with those as leading sectors, that is definitely showing risk on. One concern, of course, is semiconductors, which year to date is still up, it's still the leading sector here, up 12%, sort of took a pause. So we'll see as this thing sort of hovers not too far off the highs. I would like to see that really pick up again as well. The other thing to note, of course, is that home builders up 5%, and interesting, materials, right, which obviously home builders need to build their homes, also up 3%. So where home builders have been lagging for the week now, that was a very, very strong performance. And net for the economy, that's a positive. So when I look at the bigger picture here, I don't see any of the key leading economic indicators slowing down. So whenever you get a really nasty, protracted bear market, it's usually associated with a deterioration in the economy. And with the retail sector and home builders and actually materials led by things like copper showing strength, it's showing that there's additional strength in the economy. That's a net overall positive. All right, so that's it for now. Hope this helps, and see you next week.